Hello, everyone. Welcome. I see some of you are still getting connected to audio.
How's it going?
Good. How are you, Lewis?
Good. Is everyone all right from the earthquake?
I am okay. I hope everyone in this call is also okay.
Yep, slept through it until my mother freaked out. I thought it was her that was in danger, but it turned out it was the whole city.
Okay. I know that Ananya has a lot to cover today, so we're just going to jump right in. Welcome, everyone, to Invest in 101. My name is Reshma, Student Development and Leadership Coordinator in the Office of Student Life. We're happy to be on the fifth part of our financial health series, and we're going to cover Invest in 101. Just a few disclaimers. This session is being recorded. Closed captions are turned on. All the session in this series follow a specific format. So if you've missed any of them, it is up on our CUNY SPS YouTube channel for viewing. If you can't find it, please feel free to send me an email. I drop my email in the chat. And now I'd hand it over to my the presenter for today's session, Ananya. Please take it away.
Thanks, Reshma, and welcome everyone. Happy Friday. Today we're going to be covering Investing 101. So as usual, let's go through the agenda. We'll start with a check-in. We'll go through some large topics in investing. We'll talk about the time value of money and inflation. We'll talk about what is investing and the different types of investing. What does diversifying and risk levels mean? We'll talk about some considerations, such as fees, minimum deposit amounts, financial advisors, robo-advisors, tax implications, what platforms you could use, and then myths regarding investing. And then we'll have actionable next steps as a summary, and then we'll go through some Q&A. There are resources attached to this, which will be sent out once this deck is sent to everyone. And then we have the feedback survey. Okay, so just checking in. I see a lot of familiar faces. And so for those of us that met during the last workshop, hello again. I'm glad you've stuck on and you're here on this Friday with me. And my name is Ananya Jalan. Academically, I finished my master's in management science and engineering, which was a lot of finance, operations, engineering classes. I worked at the stock exchange and then the SEC, which is the police of financial institutions, and was a consultant for a financial health company. I want to create a dialogue to discuss financial aspects of our life more openly and remove the taboo around it. But why is financial health important? So money permeates across aspects of our lives, and it plays a part in how we interact within our relationships. And while we can't control our income levels, we can control how we feel about our expenses and our income. And I understand that you may have a number of feelings around finance. You may be overwhelmed with dealing with money or anxious, and maybe you hate all of the math associated with it. Or you may be obsessed where you log in and you check all of your accounts every day, but wherever you are on that spectrum, thank you for taking the time to be here. I also want to acknowledge the confines of the system we live in. The financial system is known to be one of the most complex phenomena created. And again, there are inequalities that exist, but what this series aims to do is to delve into these financial concepts to empower you with the means to transform your health through having more knowledge around these areas. Finance is not a one-size-fits-all solution, but after going through the workshop series, you should be better equipped with topics and information to serve you in the right direction for you. And lastly, I know this group is always interactive, but please feel free to interact through the chat, raise your hand. And I'm sure that we can all learn from each other's experiences. And as usual, the 3 people that stay through the duration of the session will be entered into a raffle to receive a wonderful book called I Will Teach You to Be Rich. And you can also enter a survey at the end of the raffle. at the end of the session to be entered into another raffle. And just as a disclaimer, I am not an attorney, accountant, psychologist, or financial advisor, nor am I holding myself out to be. The information that is contained in this workshop and presentation is not a substitute from financial advice from a professional who is aware of the facts and circumstances of your individual situation. And with that, let us begin. So from our previous workshops, we did have a piece called cash flow analysis left as part of the financial awareness blueprint that a lot of us filled out. I want to make sure that we have enough time to get into investing, which is a topic that I know many of us are interested in. And so I will be creating a video series to explain the cash flow analysis piece, as well as all of the other blueprint tabs. So it will allow those that have completed the financial awareness blueprint to finish off filling that remaining cash flow analysis sheet, which is the sheet that you would use to track your finances month to month. And then you would be able to see, you know, in the summer, if you pay more for your electricity versus, or for your gas, as opposed to, well, in the winter, you might pay more than in the summer, and it will help you plan for the future. And for those that haven't used the financial awareness blueprint, it will help you learn how to use the blueprint from start to finish. And it will also help you debug any errors that might crop up as you use your Excel sheets. Okay, so our first question is questions and fears I have around investing. I'm going to just drop the link in the chat. And I'll also expand the QR code. And for those of you that aren't able to connect to the link, you can also drop your questions and fears around investing in the chat, if you have any. No fears or no questions. Okay. You don't know anything about it. Does Fidelity invest for me? I don't know where to start at all. I have it with my previous employer. Okay. Yep, we'll be going through understanding whether or not once your money is in your account, whether it's actually invested or not. Nervous about losing money, fear of losing my initial investment, yes. I don't know if it's best to pay a mortgage slowly or quickly. So we won't, Yolanda, we won't be covering mortgages. We'll be talking more about investments here in this session. Okay, so I don't know anything, but I want to. Yep, so we'll definitely get into what investing is and learning more about it today. Just afraid I'd lose it all. Okay. All valid. Okay, so we're going to start off by explaining why should we invest. What is the time value of money? Time value of money means that money in the present is worth more than the same sum of money in the future. You might remember from I think 2 sessions ago where we talked about bananas, right? So we know that the costs of our goods and services go up each year. You might see when you go into the grocery store that the price of milk, gas, our dry cleaners, everything has been increasing. And in some years you see it increases more, and in some years you see that it increases less, right? And so this growth in costs of our everyday being is called inflation. And when the cost of your goods and services are going up, this means that you have less purchasing power with the same amount of money. So inflation has a negative impact on the time value of money. It causes our money to decrease in the future. And inflation on average is about 3% every year. So let's take an example. If you have $100 today, and let's say the price of a banana is $1 per banana. So with the $100, I can go and buy 100 bananas today. But using the fact that inflation goes up by 3% every year, which means the cost of my bananas are going up every year, in 3 years, with that same $100, we will all only be able to buy 91 bananas, which isn't too great, which means our purchasing power with the same $100 has gone down. But how do we counteract it? How do we make sure that we are still able to buy 100 bananas, right? So just in terms of inflation, what is inflation? Inflation is the increase in prices over a given period of time. And there are 3 different types of inflation, which I won't get into the details of here. They're not extremely relevant, but they will be linked in the resources section in case anyone wants to learn more about inflation. There are also 2 methods that the government uses to measure inflation, but they are within a tenth of each other most of the time. So you won't see that one method measures inflation at 5 versus the other at 3. It's usually pretty consistent, 3.3, 3.2, and so on. Now let's look at the table to the right. So if we have $1,000, today the year is 2024. We went through different types of accounts during our last like 2 sessions ago. And so we saw that the interest rate is about 0.4% in a checking or savings account. In a checking, it's much lower. Some savings accounts have gone to 0.4% this year. But on average, they're much lower. And now we're talking about a regular savings account. We're not talking about a high yield savings account. And so with inflation at 3%, in 1 year, that $1,000 that we have, that we've put into our checking or savings account, because of time value of money, that the true value of the $1,000 after 1 year in 2025 is going to be $974, which means we've lost about $25 having our money sit in that checking or savings account. But what happens if we invest that money? So the most common measurement of investing is benchmarked against the S&P 500 index. So similar to our bananas, we're going to benchmark investing against the S&P 500, which we will get into more details of. So now if you invest, the average return that the S&P 500 has given, I believe over 20 years, has been around 8%. And so now if we still consider inflation at 3%, after 1 year, if you had put $1,000 and if you had invested $1,000 into the S&P 500, you would now, after 1 year in 2025, have $1,050. So you would have gained $50. Now, what is that difference? If I am putting my money in a checkings or savings account at 0.4% interest versus Lewis, who invests his money, that difference between our money is $75. I have lost 25 versus Lewis has gained 50. And so that $75 difference shows the difference between the person that invests versus those that don't. Now let's look at the yellow columns. In the yellow columns, let's see how it affects someone over a period of 5 years. So if I have money in my checking or savings account, that same interest rate of 0.4%, it's actually historically been much lower. I am going to lose $125 over 5 years of keeping that $1,000 in my account. So now my money in that day has become $876, which is in 2029. If Lewis has invested his money, again in the S&P 500 index and saying an average rate of 8%, Lewis has gained $225. And so that difference between me and Lewis now is $350. I've lost 125 and Lewis has gained 225. And this is just over a period of 1 year versus 5 years. But if you think long term and with more money than $1,000, that money really starts to add up. So let's look at a larger sum of money and how that affects $50,000, right? And I heard some comments in previous workshops about the rich getting richer and the poor getting poorer. And you can see why based on this chart. If we keep our money in a checkings or savings account, now with that $50,000, if I've kept my money in a checkings or savings account, I have lost $1,300. So my final value of money after 1 year in 2025 has become 48,700 versus Lewis. And I'm sorry to continue picking on Lewis, but I know you're a good sport.
Yay.
Sorry, Lewis. I didn't hear you.
No, I was just going yay because you used me as the one that gained.
Oh yeah, of course. So if Lewis now has invested his $50,000 in the S&P, after 1 year, Lewis has 52,500. And now you see those gains and those losses start to add up, because compared to me, Lewis is $2,500 ahead plus another 1,300 because I've lost 1,300. So Lewis is $4,000 ahead of me. And now let's look at it over the period of 5 years. Over the period of 5 years, my money in a checking or savings account has lost $6,200 versus Lewis has gained 13,800. So that difference between me and Lewis is $20,000 now. So I hope this helps all of us see the difference between our money sitting in a checking or savings versus investing that money. And the main takeaway here is that difference, but it's also, we need to understand that every person's situation is different. And so we need to think about our emergency funds, whether we put that in a high yield savings account. So Lewis, yes, to your point, a high yield savings account is generally safe from inflation. So in terms of inflation, which is usually on an average 3%, most high yield savings account will give you about 4.5 to 5%. At least that's what we've seen in the recent years. So it helps you there, but on average, compared to the S&P 500 index, which has long-term averaged 8%, investing is better once you've put all of your money aside from your high yield savings accounts, any money you want to put into your emergency funds, any school fees you have to pay, groceries, car payments, loan, mortgage. Once all of that's done, if you have money left over, it would be wise to invest it. And if you have a lot of disposable income, and you can afford to take out a certain amount to invest every month before your expenses, please consider doing it. And whether it is $50 or $5 or $500, investing long term, because of this difference between your checkings and savings and your investing, will make all of the difference. And so if you look at it on a longer scale, if you invest $10 per week, after 1 year, you have $520 that you've invested. And after 10 years, you would have about 7,000. If you invest in the S&P. Sorry, Lewis, go ahead.
No, I'm sorry. I just want to quickly clarify. So a high yield savings account, like I won't lose money, but I won't be making nearly as much compared to like if I invest in the S&P 500.
Correct. Yes. Generally speaking, the S&P 500 does have a better return. You would make more money in the S&P 500 long term. We do need to understand, which we will go through in the next few slides. One, to your point, high yield savings accounts recently have been giving high returns of about 4.5 to 5% per year. But again, that's something that you need to make sure that you're consistently checking to make sure that that high yield savings account is not going below the inflation rate, or the inflation rate is not coming too high above your high yield savings accounts.
Gotcha.
And yes, S&P 500 on average long term has been better. So if after all of your immediate important payments that you need for your being, if you can invest money with money you have left over, that is a a good practice to get into.
Gotcha.
Yeah, thanks for your question. Okay. Moving on. What comes to your mind when you think of the word invest? Stocks, money. Yep, a lot of us do think of stocks, but as we will learn, it is a little more than stocks. And there's safer ways than pure stocks. Wall Street, savings, okay. Intimidating, yes, high risk. A backup plan. Risky. No doing need. Okay. Next question. I invest. Yes or no? And invest can be personal investments or retirement as well. If you have a 401k or a 403b, ultimately they feed into financial instruments that are investing instruments. So just in case you do know that you're putting money into a 401k or a 403b or any kind of retirement accounts, that also does count. I
Ananya,
see a couple of yeses. Fine. Yep, Lewis.
just very quickly, are we gonna like go over 401ks and Roth IRAs in this session?
No, we will not. Not in
Oh,
this
okay.
session. We'll touch upon it more in the next session.
Oh, okay. I thought like
Yeah.
investing, because like I was thinking investing in retirement, so like that's what I automatically came to mind when I saw the schedule.
Yeah. No, we'll talk about target date funds, which are used for retirements in this investing in today's session. We'll talk about it more in detail in the next session. But we'll touch upon target date funds, which are funds or investment financial instruments that are invested into through your retirement accounts.
Gotcha.
Yeah. Okay, so we see 86% of us have said no, we don't invest, and 14% of us do invest. I need to be sure of what I'm doing. Okay. Okay, so let's go into what it means to invest. What is investing? It is putting your money into assets with the expectation that the money will grow. So let's break this down a bit. What is an asset? An asset is something that you invest in. It can be stocks, bonds, cash, but it can be anything that has economic value, including a home or a car. We might buy a home. We think that the price of our home is going to increase, and we want to sell it in the future, and we believe that that asset will grow. An asset can also be a group of investments that exhibit similar characteristics and are subject to the same rules and regulations. So when you go to the grocery store and you're picking out cereal for yourself or for your family and your kids to grow and be healthy, you're looking at certain areas of the cereal, right? You're looking at expiry dates, you're looking at ingredients, how much sugar is there, how many calories, any dietary restrictions that you or your family might have. And so similarly, when we're looking at money, what do we need to consider for our money to grow and be healthy, right? Similar to when you're going and picking out cereal. I know it's not the same, but as close as we could get. You're looking for a mix of things that suit you. Your investing considerations are very similar. So let's take a look at what we should look at or what we should consider when we're investing. So similar to an expiry date, with investing, we might consider the time frame of investing. Are we investing for a year down the line? Are we investing for 5 years, 10 years? In terms of risk, we could compare it to sugar. How much risk am I willing to take? How much sugar am I willing to give to my children in the morning? Because that's going to compare to how much energy they have and how much energy I have. And then in terms of the other investing considerations, those would be determined by your knowledge areas. If you're passionate about sustainability, you're passionate about tech stocks, you're passionate about education and the education sector and so on, and also what aligns with your moral values and your beliefs. So that's similar to if you're picking out cereal and you really prefer oat flour or almond flour, or brands that prefer, certain ingredients to others. And so investing considerations are very similar. And usually when we're talking about investing, we hear a lot about the stock market. Now, what is a stock market? It's a place where buyers and sellers meet to exchange equity shares of public companies. So you also might have heard about the US stock market having been considered one of the greatest returns for investors, which outperform all other types of investments, including financial securities, the real estate market, commodities. It outperforms art collectibles over the past 100 years. But let's break some of this down. Recently in the news, I believe a week or two ago, I think it was CNBC, they talked about how 93% of the stock market is held by 10% of the richest people, which means that those gains of the stock market, which is one of the greatest source of returns, is going to the richest people. And if the richest people are holding so much of the stock market, there must be a reason. So let's investigate a little further and try to understand this better. There are, on the right-hand side, you'll see a table where we're talking about different categories. And these are a lot of terms that you hear in your everyday, in your day-to-day life. And they may fall into one of these categories or a subcategory within these categories. But let's break it down and try to understand each of these investing categories, what their definitions are, and then also their risk levels. Because I see a lot of us have talked about how we think investing is risky. And that is true to a certain extent, but it's determined by what we buy in terms of investing, which is risky. Like you could go into a grocery store and you could buy a cardboard box of milk versus a plastic box of milk. Or you could buy a glass bottle of milk, or a glass bottle of pickles. And the glass bottles are more risky because if you accidentally drop it, it has more risk of breaking. Versus if you're buying a plastic bag of chips, it has less risk of breaking. And investing in various financial instruments is very similar. There are certain categories that are much more risky versus some that are less risky. So we'll talk about that in a little more detail. So let's look at our table. Let's look at that first row, which says individual stock. Now, what does individual stock mean? And that's usually the first thing a lot of us think about when we think of investing. We think, oh, stocks. But there are a number of different items that we can also invest in, which is what this table shows. But what is stock? Stock is shares or partial ownership in a company. So if Facebook has 2.5 billion stocks, and you own 10 shares of Facebook, you own some very small percentage of the entire company. And when that company does well, you do well. But if the company doesn't do well, you don't do well, which means it's very high volatility. What does volatility mean? It's a measure of how much something changes. So with stocks, it's very, sorry, give me 1 minute. Apologies. Okay. So volatility means the amount of fluctuation of something. And so with stocks, it's determined by the company that you have bought shares of. So if that company does well, then you do well, and if the company doesn't do well, then you don't do well. What are bonds? Bonds are debt. They're debt obligations of companies. So it's like you're giving a company a very small loan, and they're going to give you back the money you gave them, but with a little extra money, a little extra interest. And because of that, they're lower risk. They are promising you back a small amount of money compared to what on top of what you've given them. And so some bonds are treasury bonds. Oops, sorry. Did someone say something? Okay. So there are a couple of different types of bonds. You can give money to the government, or you could give money to corporations, which are companies that are expanding and require money. Sometimes the government is trying to invest in renewable energy or in sustainability, and so they give out these things called green bonds. And then, so most of these bonds that are given out by governments or corporations are lower risk, but they're also lower return, which means compared to a stock, let's say, for example, a lot of people might have heard of Tesla, where they started off where their stock was about $70 and you bought one share of stock and it was 70 versus, in a couple of years, as they started selling more and more cars, the value of Tesla grew. They were making more, they were providing more services to the US, they were expanding outside of the US, and their stock price went through the roof. And then if you owned one share of Tesla stock from $70, if you had bought a share at 70 and it went to $400 and you sold it at $400, you would have effectively made 330 minus, your all of the capital gains taxes. But that is where stock is volatile. You can make a lot of money if a company does well, or you could also lose all of that money if a company doesn't do well. Let's say you bought it at 400 and then it fell to 200. That meant you lost $200. But that's where funds come in. What are funds? Funds are a bag of instruments that you can invest in. So it's like a group of stocks. So, when you go to the grocery store and you buy those ready-made gift baskets that have, they have some chocolate, they have some chips, they have maybe a jar or two of a spread, and they've mixed it all together. That's very similar to funds. They can have thousands of different things in that one bag. And usually this is less risky because let's say you have a bunch of technology stocks, and you have some real estate mixed in, you have some pharmaceutical stock mixed in. What happens if some of them go higher than the others? If all of the tech stock are doing very well, but some other areas are doing less well, they kind of even out. And so in general, because of the law of averages, investing in funds is less risky. Now there are, again, different type of funds. So let's go through the different types of funds. The first is mutual funds. These are actively managed funds that try to beat the market. And usually beat the market is that baseline of the S&P 500, which on average is 8%. So you have fund managers, which are people like you and I, who are sitting and saying, okay, let me mix a couple of Facebook, 10% of Facebook, another couple of percent of Tesla, maybe a couple of percent of AbbVie, and so on and so forth, where they're mixing a bunch of different stock and they're saying, okay, let me try to get more than 8%. But because you have people that are sitting and doing all of this actively, mutual funds cost more. They take more money out of your pocket. And so because they have fund managers, those expense ratios, which we'll get into, we'll understand what expense ratios are, but the amount it's going to cost you is more. And sometimes they beat the market, but on average, I think it's more than, I think it's about 20% of fund managers, or maybe even lower, that don't beat the market. So sometimes it's actually just safer to invest in the second type of fund that we're going to be talking about. And the second type of fund is called an index fund. An index fund is a passive fund, which means there are no people sitting behind it actively deciding which stocks to pick, or which groups of instruments. It could be some stocks, some bonds. There's no one sitting behind deciding which ones to pick. An index fund will mirror a market index, and we will also get into what a market index is, but we've been talking about the S&P 500, which means, so the S&P 500 is the stock basket of the Fortune 500 companies. We've all heard of Fortune 500 companies, which are based on how much market capitalization they have. That means the more number of stocks and the higher price of those stocks, the top 500 of those companies fall as Fortune 500 companies. And so what index funds do is they try to, so if the S&P 500, all of those 500 companies in whatever proportion they are in the market, if Apple has the highest market capitalization, then followed by Facebook, then followed by Tesla, then followed by so on and so forth, that in that exact proportion, you will have the S&P 500 index fund. It is tracking the S&P 500 index. And generally, the index funds have a much lower expense ratio. And like I mentioned, for the S&P 500, on average, you're getting about 8% of returns every year. And next are exchange-traded funds. So these are a type of investment fund that is traded on the exchange. So similar to mutual funds, what is the difference between a mutual fund and an exchange-traded fund? A mutual fund you will buy from a brokerage or directly with the person creating the fund. So if let's say Yolanda was sitting and deciding which groups of stocks to pick and choose for her basket of shares for her fund, I would go to the brokerage or the company that Yolanda works with, or Yolanda's company herself, or maybe Yolanda sells to someone else and I buy from that company. But you can't trade it on an exchange. I would have to go to specific companies or the person that is making the fund to buy those funds. Versus exchange traded funds are those that you can buy on an exchange. And the last type of fund that we're going to cover, which is a retirement age-based investment, are called target date funds. What target date funds do is, let's say you are set to retire in 2040. So an age-based retirement investment helps you take more risk when you're younger because they know you're generally healthier. You'll be able to make a little more money when you're younger than when you're older and you're trying to, take care of your health more. Your risk levels are reducing. You're trying to become more conservative with your money over time. And so what target date funds do is they will automatically adjust where they invest in more of those risky but high gain stocks or funds during the initial course when you're younger. And then towards the last few years or last decade, they will become more conservative and invest more in your bonds that are much safer. And now what are derivatives? So the next category is derivatives, which derive their value from another financial instrument. What does this mean? So today is April 5th, right? And you go to your Target or your Stop and Shop or your Walgreens, wherever you buy cereal from, and you buy a piece of paper from them that allows you to buy a box of, let's say, Captain Crunch cereal or Trick cereal or whichever cereal you like for $3 before the end of June. But now it's May 10th, right? It's a month from now. And something happens and Captain Crunch cereal or whatever cereal you like has gone to $5 a box. But now you have this piece of paper that allows you to buy it for $3. So you're feeling really good about yourself because now you can go on May 10th and buy that box of cereal, which is $5 for only $3, right? So how much have you effectively paid? You've paid $3 for your box of cereal, and you've paid $1 for that piece of paper. And so you've paid effectively $4 for your box of cereal. So you feel great about yourself. You've saved $1 compared to everyone else. But now let's look at the flip side. Let's say you buy that piece of paper for $1, which allows you to buy your favorite cereal for $3 before the end of June. But now it's May 10th, which is a month from now, and that Captain Crunch cereal box is only $1. So you wouldn't exercise that piece of paper. You wouldn't give that to the manager and say, I want to pay $3 for this box that is actually only $1, right? So effectively, you've lost that $1 that you've paid because you're never going to use that piece of paper now. And you've paid $1 for your box and $1 for that piece of paper. So you've effectively paid $2 for your box of cereal when your box of cereal was only $1. So this piece of paper, which is an option for you to decide whether you want to buy or sell something, that is called derivatives. And you can use derivatives on top of these other financial instruments. But that is, again, going into a lot of detail and coming from a perspective where you've never invested, it's best to start off with funds that have low expense ratios. And we're going to get into where should I invest shortly, but let's go through the last two categories of investing. Now, at least you know, or you understand with an example, what are derivatives or options. But it does take a bit more skill and nuance to use derivatives and options. So as someone who's investing for the first time, I wouldn't want you to go and use derivatives and options unless you're very secure and you understand thoroughly what those mean. But it's good to understand what these are. So our fifth type of investment is REIT, or investment trusts. These are what help invest in groups of residential or commercial properties. The risk level varies across the board because it's determined by where those REITs are being invested. So if you're someone that believes in real estate, or if you want to diversify your portfolio, which we will get into on the next slide, REITs are lower return, but varying levels of risk. And the last investment area we're going to get into is commodities. So we might have heard this term quite often. There are commodity exchanges where you can exchange metals, oil, grain, animal products, currencies, and other financial instruments. You can do copper. Yeah, sorry, to Lewis's point, REITs are an excellent alternative to real estate. You're not investing in actual real estate and buying a whole house. You are investing, your money will be going to multiple, like small percentages of different commercial and residential properties that are being built.
Yes, and I want to say very, very quickly that it's also better because, like, for someone who doesn't want the headache of like dealing with like repairs and like or bad tenants, so, like myself, so like I wouldn't want to deal with that. So REITs are perfect.
Exactly. And commodities, again, very similar. You're not dealing with you're not physically buying, 10 tons of copper or gold or silver or grain. You are investing in money, or you're investing your money into these various areas through the exchanges. Okay. So now, where do I invest and what is the risk of investing? I think this is where the meat of everything that we usually want to know about investing lies on. So what are some of the platforms where we can invest. The three platforms that I would suggest are Vanguard. Vanguard allows you to invest in low-cost funds. The second is Fidelity. I remember that someone initially brought up Fidelity. Fidelity is a very detailed platform, but can also be a very heavy interface to use in terms of lots of tabs, and we may not always understand every single aspect of the website. That could be heavier than Vanguard. But if you are someone that likes that amount of detail, then Fidelity is a great tool as well. Then Charles Schwab. At schwab.com, it's beneficial for automatic investing. And I know a lot of us might have heard of Robinhood here. Robinhood has become popular, but personally, I would advise you to steer away from them. Robinhood has limited education opportunities and research tools. It's also much more difficult to manage your portfolio, especially if you want to diversify your portfolio, which we will understand in just a minute. And last I checked, I believe they don't offer you the opportunity to buy bonds or mutual funds. And for some of us, we might want to, again, funds and bonds are lower risk investments, and they may not allow you to purchase any of those or invest in any of those. There's also a certain amount of risk with investing. So the three areas of risk are low, medium, and high. And again, these are something that every individual needs to consider because there is an amount of risk associated with investing, but we've gone through on the previous page and tabulated which areas have more risk and what factors we should consider. But let's understand what diversifying is. Diversifying, and for all of those that believe that investing is risky, this helps us de-risk or reduce the risk of investing. So diversifying is the act of spreading your money across a range of assets to reduce investment risk. That means having a mix of classes of stocks, bonds, mutual funds, and cash, or you could do a mix by industry or geography or company size in order to minimize your risk. Right? So the goal of diversification is not necessarily to make sure that we're making, 50% returns and like boost performance, because it doesn't ensure that you're going to get those kinds of gains. And it also doesn't guarantee us against losses, but it improves returns for whatever level of risk you choose. So let's look at how we can invest. And the model that you see on the right-hand side is a baseline. It's by an investor called Swenson, and it shows us how we can, in what proportions we can invest in to make sure that the rest of the portfolio would grow or at least not decline as much. So looking into it, so 30% of your portfolio would be in the US total stock market. That means stocks of US-based, US-listed companies. 15% in total international without the US. So companies that are listed in other countries except for the US. 5% in emerging markets. 15% in intermediate term treasuries, which are treasury bonds, which are not very long term, but they're intermediate. REITs and TIPS. And another portfolio example is, so now these are large categories that you see on the right-hand side, but now you'll ask me, well, what am I actually supposed to invest in when I go into my investment account? How do I invest? And so on the left-hand side, we see a portfolio example made of Vanguard funds. So you'll see the top line, which are stocks. Those are groups of stocks. So you're investing in companies. And the bottom line is of bonds, which means you are giving that small debt or small loan to corporations or governments. So I'm just gonna let this sink in for a minute. Does anyone have any questions in terms of diversifying or the portfolio example? So each of these stocks, these different funds, if you go and you type in VTSMX in Google, you will find all of the companies that this particular fund is invested in, along with their percentages. So similar to if you go into a grocery store aisle and you buy some Lay's and some, you balance the healthy food with the unhealthy or the seemingly unhealthy food, where you'll buy a couple of packets of Lay's, you'll buy a couple of vegetables, a couple of fruits. You're mixing and matching in order to be as holistic as possible, but also make sure that what you're getting makes you healthy and then also provides you joy. And so similarly, stocks and bonds and diversifying helps do that, where you're getting a mix of things, a mix of company stocks or a mix of company bonds that help improve your gains based on your level of risk. So we will send out these materials. So if you want, you can go into, again, this is just a portfolio example from Vanguard that helps diversify your portfolio. You can look into those individual areas and learn more about them. Okay, for those of us that invest, what platforms do you use? Webull, okay. I heard someone say Fidelity when we had initially started as well. Coinbase, okay. I see some crypto. Charles Schwab, Marcus, Coinbase, Sophie, okay, SoFi. So a decent number of platforms. I see a lot of Coinbases. A lot of us are into crypto. Real estate. Do you mean physical real estate or REITs? My job uses Empower. Okay. Also use Stash. Physical real estate. Okay. Robinhood. Okay. Combination of 401(b) and investment property in Vermont. Okay. So a mix. We have a number of platforms which folks use. Okay, let's get into some investing considerations. I believe someone said they use Fidelity, but they don't know if it's truly invested or not. So one of the first things that I want to say is that when money is transferred into your investment account, usually whichever platform you use, it will sit in something called a money market fund. A money market fund is a type of mutual fund that invests in cash or cash equivalents, which means that your money is sitting in a very secure, generally very safe account, but it's gaining little to no interest. And so whenever you transfer your money into an investment account, you need to purchase something with that money. You need to buy funds or you need to buy stock. And so If you don't do that, your money is just sitting in a money market fund for most of its time. But let's go into some of the things that were mentioned earlier. What are some minimum investments required on some platforms? There are some areas that require minimum balances or contributions of $1,000 to $5,000, but in a lot of cases, it is $0. And so don't be overwhelmed with the minimum investment. Usually before purchasing, you will be able to see the minimum amount required for you to invest in that particular fund or investment area. What are the fees that we should consider? There are expense ratios. Expense ratios are the cost of operating that fund. So that will go to management, it'll go to administration fees, it will go to marketing for that fund, you know, those billboard ads and things you see in the buses for that fund. You have transaction fees, which are the cost of buying and selling. Usually that tends to be very low. There are also some that have no transaction fees. There are investment or annual fees, which is usually a one-time yearly platform fee, which again, in most cases is zero. So if you have an investment account which is charging you for an investment or annual fee, please consider switching to a free account. Vanguard, Charles Schwab, and Fidelity are, I believe if you have less than $100,000, they have zero annual fees. And then there are transfer fees. Transfer fees are fees that are associated with moving money in or out of the investment account. As a general rule of thumb, your expense ratio for a fund, especially an index or an exchange traded fund or an ETF, should be below 0.3%. Okay, now what are some features that you could consider when choosing an investment account or an investing platform? Some things that we might consider are how the mobile application looks like, whether the website is easy to navigate, whether they have good customer service or not. And just some tips. So Warren Buffett thinks financial advisors charge too high fees relative to the value they provide. So many financial advisors will charge a 1% management fee, which seems very reasonable to ordinary investors, but it adds up. So imagine you're 30 years old and you choose to invest $50,000 and you make contributions of $1,000 per month. In 35 years, if you had a 0.2% management fee, or that expense ratio, if you were investing by yourself, let's say you were investing in the S&P 500 only, and you have a 7% return, which is lower than the actual S&P 500 return, you'd have over $2 million. It's worth noting that in case you paid a financial advisor 1%, you would have $1.7 million if you chose to invest that $50,000 and make contributions of $1,000 per month. And so just that 0.2% versus the 1%, you think it doesn't seem like that much. You think that 1% doesn't seem like that much, but you are giving about $300,000 to $400,000 to your financial advisor. And so before hiring a financial advisor, please think twice, because you can invest again at a baseline and the S&P 500 index funds, which again have an 8%-ish return with a very low expense ratio. Now, what are robo-advisors? Robo-advisors are computers that align your investments. They have lower fees than financial advisors, but higher fees than your low-cost funds. So if you want, you could put some of your money in a robo-advisor and invest some of it yourself. But robo-advisors, again, you should be mindful that the amount that robo-advisors cost, it's not free. You do have expenses for robo-advisors. And they can be higher than a general low-cost fund. And the last is tax implications. Tax implications, you have short-term gains, which mean that anything that is sold within a year or less, if you sell an investment, and if you've earned a profit, it is taxed at a higher rate than long-term gains. It is taxed in your tax bracket as ordinary income that is coming to you. Long-term gains are usually anything that's held over 1 year. And also you might have heard of the term dividends, which are stocks that are paying you some money, or funds that are financial instruments that are paying you a small amount of money for holding those stocks or those funds over certain periods of time. And those can get reinvested back. And those are also taxed. Those can be, again, long-term capital gains, or they can be non-qualified, which means that they are taxed at your ordinary income tax rate, which is generally higher than the long-term capital gains tax. Okay, what are some myths and tips about investing? So there are these two very common phrases that you might have heard, which is timing the market versus time in the market. So time in the market means long-term investing. Start today, be consistent, and make sure that you are maximizing the true duration of time you are in the market. Timing the market is when we try to actively find opportunities to enter the market when it's lower and exit the market when it's higher. But in reality, we find that time in the market is better than timing the market. So our takeaway here is be consistent. Another myth is that you need a lot of money to invest. That is absolutely not true. For many funds that we talked about, there are no minimums. So an example is FXAIX, which is the Fidelity fund that tracks the S&P 500. And I would say that for anyone that is worried about investing, the two areas that I would consider you or urge you to look into, one is an index fund that tracks the S&P 500 if you're looking at long-term investing, and the second are retirement or target funds. We talked a lot about those abbreviations, FXAIX, AAPL, or you might have seen Tesla, TSLA. What are these? These are ticker symbols or stock symbols. They abbreviate publicly traded shares of stock on the stock market. So it allows you to identify a particular stock, and it's just a shortened or abbreviated version of it. Now, what is saving versus investing? The biggest difference between saving versus investing is the level of risk. Saving typically results in earning a lower return, but almost with very, very minimal risk. Investing allows you to earn a higher return, but you take on the risk of loss. Long-term, investing makes a very big difference. And again, in terms of investing, it's very good to start basic and then build up. Like for example, for your first car, many of us would not go, if we had the money, many of us would, start with a normal car to understand how we can drive and learn how to drive instead of going and buying a Ferrari. So please don't think that I've learned about investing, tomorrow I'm going to go and, invest a ton of my money. Start small. And for anyone starting off, There are two investment advisors. One, Ramit Sethi, says, as an 85% solution, invest in a target date fund. And Warren Buffett says invest in an S&P 500 index fund, which is FXAIX, for example. And then you have Vanguard has its own index fund that tracks the S&P 500 as well. And the last piece is what I had started off with, is that when you open when you open your account and you add your money in, your money is sitting in a money market fund. You need to actually put that money into something. You need to transfer it into a fund. You need to buy shares, or you need to buy stock parts of an ETF. So actually buying the fund or buying the investment that you're looking into. And then lastly is fears versus your fears versus your feelings, right? So be disciplined, cultivate patience, and invest for the long term. Immediately when there's a fluctuation, you're investing for the long term. Don't react with every fluctuation if you can afford to stay the course. And the tip is do your research, start slow, be consistent, and then build up. Again, it's not like owning a new car and then going and buying a Ferrari. And I know we're past time here. There is an activity to help you understand the time value of money, which I will send across when we send all of the resources. But just summarizing, what are some actionable next steps? What did we learn today? We learned why we should invest, what that difference looks like in terms of 1 year, 5 years, and imagine if I'm losing $20,000, if the difference between someone who has invested and someone whose money has sat in a checking or savings account for $50,000, if that difference between me and Lewis who invests is $20,000 in just 5 years, think about what happens over 10 years and 15 years and 20 years, right? So we learned why it is important to invest, what it means. We also learned about diversifying. We learned about different platforms we can use to invest, and different investment types. There were examples of how you can diversify your portfolio and what are some funds that you can invest in. We also went through some considerations and some myths and some tips. In next steps, once you receive the videos on your financial awareness blueprint, please go back and update your cash flow analysis for the months of January, February, and March. Research more in terms of the platforms that were suggested and learn more about the platforms you invest with. Plan your strategy. You can use Swenson's method. You could use the Vanguard example that I had given. Transfer your money and buy your funds and investments. Don't let your money sit in your money market fund. And just as two examples, Ramit Sethi says you can start off putting your money in a target date fund if you feel like you don't want to manage it. Or as Warren Buffett says, you can put it in a low-cost S&P 500 index fund, which gives you an average return of 8%. And again, our next series, our final session is on April 12th at 1 p.m. We will be going into family financial success. We'll talk more about retirement accounts. We'll talk about life insurance, 529s, and financial tools for children. And we'll briefly go into joint credit cards. Again, apologies for taking an extra 10 minutes, but I appreciate everyone being patient. And does anyone have any questions? I see, can we have a recorded version? Reshma, will you be sharing that?
Yes. Before we jump into question, I want to say thank you, Ananya. I'm going to stop the recording and just leave everybody to just ask their questions here.